Morning. It's December 3, Friday, and it's what time is it? 6:16 a.m. Welcome to episode 25. Good Friday morning to you, Wawi.
Good morning, Mark.
It's been a while. It's been a couple of weeks that we took a break. How are you, Wawi?
I'm doing fine. Just finished with Thanksgiving. How about you?
Great. Had a great Thanksgiving too. I hope our listeners had a great week too. This is your host, Mark Yu.
Wawi Santos.
And welcome to the Markio and Wowie Show. A disclosure: this show is made for information purposes only and entertainment purposes, not to be considered investment advice. We record once a week, or we try to. I and Wowie are physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. Show's goal is to share and learn from each other and answer some questions. And to our co-workers in the medical field, thank you guys for your hard work. We are available in YouTube, Spotify, and Google Podcasts. On our previous episode, we discussed Elon Musk selling. So far, he had sold about nearly $10 billion in just November alone. I forgot it's already December. So this week we're gonna go through a bunch of information since we missed out at least a couple of weeks. So we have the consumer sentiments, and of course the stock market sentiments. So let's proceed. So finally, Senate passes funding bill despite vaccine mandate flap. So at least the government will be funded until February, I believe. So that's good news for the market, right, Wawi?
Yeah, the market needs stability because it's volatile.
Right. It's been wild roller coaster ride in the past week alone since the a new variant has emerged Friday.
Mhm.
We're going to take a closer look at the market reactions in a little bit. But this is also new. At least the federal chairman, Jerome Powell, decided that it's the right time to retire the word transitory and the transitory inflation that he was been pushing
Yes,
since mid this year. So,
that's good as long as he does not retire. He can retire the word transitory, but he should
mhm,
stay.
right. Oh, sorry about that. Let me lower down the volume. So, according to Jerome Powell's prepared speech, quote unquote, we tend to use the word transitory to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean. So right now, the inflation actually is highest in the last 31 years or 32 years, and some experts are saying that it's no longer transitory and it's affecting consumers, which we're going to be glossing over in a few minutes. So according to the Jerome Powell, the economy is very strong and inflationary pressures are high. It is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases perhaps a few months sooner. So not only he's looking to forego the word transitory and inflation, but he's also looking at being a little bit more hawkish and being tapering more asset purchases a month sooner. So not a mention of rate hikes, but he's just trying to pull some liquidity out of the market.
Mhm.
So this is interesting because people are looking closely what he's gonna do. So ever since then, ever since his Tuesday speech, I think stock markets has gotten more volatile, right, Wawi?
Yes, it has been. The
Mhm.
VIX index has been up, and the S triple Q has also been up this past few days.
Right. And going by to our consumer sentiment, which consists, according to Charles Schwab research, consumers consist of 70% of the U.S. economy. So whatever the consumer does, the U.S. market follows. Eventually, the stock market does as well. So according to the University of Michigan surveys of consumers, it's November, which just passed us. It's just December 3rd as of today. So the consumer sentiment has dropped 12% in November. from a year ago. So from 76 or 77 in 2020, it dropped to 67.4%. And their expectations also dropped nearly 10%. So consumers are feeling the heat in inflation, more expensive goods, like what we pointed out just an episode ago. So definitely they're not looking bullish at this time on buying goods. And we're gonna run through a graph in a little bit that shows like their appetite for bigger purchases like trucks and houses and all that. So this is a chart from Fred data, the University Consumer Sentiment. So we're off our highs. Our highest this so far this year was back in April. We were at 88.3 at one point, and now we're down to 66. What did this? 67.4 as of last month. So quite a drop. Consumers are feeling the heat, and this is an article that was just published over like 3 days ago. It's entitled "Fewer People Shopped Over Thanksgiving Weekend Than Last Year." Store traffic was up, but online activity eased as retailer offered fewer discounts due to limited inventory. So it's not a byproduct of um, consumer fears or consumer hesitation of inflation. I believe it's also because of the pull ahead, pull forward of people already purchasing their Christmas presents or gifts at least last month or months ahead, right, Wawi? Because I think we've been reading some news that consumers were piling in or trying to order their goods or gifts in advance just so they can prevent like delays. You don't want to ship or you don't want to order and have it shipped last minute and not arrive before Christmas because that will defeat the purpose. What do you think about this, Wawi?
Well, we've been impacted by the supply shortage. That's why we're being encouraged to buy Christmas gifts early on back in September. But then
Right.
we were hit by the shortage in in retail supply, and we're suffering that issue right now. Last year we had sales increase of 8.2%. I don't know
Uh-huh.
what's gonna be this year. It was predicted to be like 10.5% increase this year, but I'm
Right.
doubtful we'll meet the same increase this year.
Mm-hmm.
But it will be nice to know after December to see what our holiday sales are gonna be
Well,
for.
I saw this report just the other day. Retail
Mm-hmm,
Next. It's a firm that kind of tracks the shopper. Shopper
mm-hmm.
counts in thousands of stores with cameras and sensors, and they said that store traffic actually rose. So this article that we just read, fewer people shop over Thanksgiving weekend than last year. This is quite contrary to it.
Oh,
Retail Next says store traffic actually rose 61% this Black Friday compared with last year, but was down 27% from 2019. So it could be that
oh.
we're comparing this from COVID and pre-COVID years. So people are definitely going buying online, e-commerce, but store traffic is below 27% compared to 2019. Last year, obviously, if you compare it last year, people were just in the midst of taking their first shots of vaccine when Moderna and Pfizer came out with their COVID vaccine shots in November, I think, or December. So people were just getting out and enjoying their freedom after long months of being locked down and locked out in their homes. According to the same firm, the Thanksgiving holiday weekend was also the first time in years that online retail sales didn't increase. So I apologize for that. So actually, online sales didn't actually increase from last year. Online Black Friday sales fell to 8.9 billion from 9 billion last year, according to Adobe.
Mm.
So the Black Friday online sales fell by 100 million, according to Adobe research, whilst Thanksgiving Day online sales were roughly flat, according to Adobe. So not only the store traffic has declined from 2019 and during last year's compared to last year's pandemic, also online sales. But I'm thinking like what we have just talked about, Wowie, that probably buyers or shoppers have already purchased ahead of time, so that not waiting for the deals in Black Friday.
Mm-hmm.
Yeah, so consumer sentiment is down. It's been trending down since April. And now, interestingly, credit card applications have hit pandemic high. So almost 27% of US consumers said in October that they had applied for a credit card in the past 12 months. So this kind of like justifies our finding just a couple of episodes ago or a couple of weeks ago that savings rate among US citizens or US consumers have been going down to pre-pandemic levels. So people need to find some sort of ways to fund their spending, and close to 27% of US consumers said in October now have applied for a credit card. This is the highest level since 2019 and well above the record low of 16% recorded a year ago. So if you're going to look at the chart, looks like it's still within range bound. I mean, this is just pandemic high. But yeah, we have just hit like 27%. If you're gonna take a closer look at the year 2019, it's always been 26, 28, 30% of US consumers. So this is just a graph of the Thanksgiving shopping that just happened this weekend. It's almost flat, and we actually dipped in the Black Friday shopping. For Cyber Monday, we actually also dipped $100 million, but almost like flat as well. And on to our next slide. This is the large purchases segment that we're talking about earlier, the consumer sentiment. We're looking at consumer appetite for houses, vehicles, and large household durables. We're going to take a closer look at it. Past 2020, we're now at the lowest sentiment for buying conditions for houses, vehicles, and large household durables. So definitely this is in support of the current low consumer sentiment that we're experiencing. We have not been in this level since 1982. So consumers are indicating or exhibiting some red flags right here. And for our next topic, it says here the ADP National Employment Report. This came out just yesterday. So actually today is the first Friday of December. So we're going to be expecting government numbers coming out in the news wires, at least before lunchtime today. But ADP is showing good numbers. Overall, all private sector, different types of sizes of businesses, from small, mid-sized, large businesses. Small meaning 1 to 49 employees, large meaning 500 more, showed overall increase in their hiring, which is really good for the economy. People are getting back to work now, and jobless claims are dropping to new lows, which is definitely indicative of a recovering economy. So it says here in our CNBC article, I think we lost Wowie, but all right, he's back live. Hello, Wowie. There we go. So this is an article from CNBC. Jobless claims less than. Wowie, can you hear me? We're having some technical issues right now. Hey, Wowie, you got disconnected. Can you hear me? You're on mute, I think. But yeah, we're going to proceed with the CNBC article. Jobless claims less than expected as labor market returns to pre-pandemic self. So we're making good progress in terms of our job recovery market. So while we're seeing, let's see. Hey, Wowie, now I can hear you. Hello? Can you hear me?
Hello. Sorry about that, Mark. I lost my signal.
That's fine, Wowie. It's now you're back, so that's what's more important. So I just was going over the the sentiment for large expenditures. So here we are, the houses, vehicles, and large household durables. So as you can see in this chart, as I was pointing out earlier, this kind of like reflects the decreasing consumer appetite in the Michigan survey. So we are now looking at very low levels of buying conditions for houses and vehicles, not seen since the 1980s. So what do you think about that, Wawi? People dumping, not looking forward to buy homes right now, or what?
Well, a lot of my friends are doing the same thing. They're holding off on buying their first home.
Right.
Um, I have a physical therapist friend that was like wanting to jump into the bandwagon and start buying want to buy her first home.
Oh.
Um,
Uh-huh.
we kind of talked her out of it because
Oh.
we were wondering what her real purpose for buying was. Why do you want to
Right.
buy a home?
Mm-hmm.
Well, it's a good investment, she said.
Uh-huh.
um, but the home prices are so high right now
It
that
is, yes.
she may not realize the cost burden that she's gonna get.
It's
Anyway, she's holding off on
uh-huh.
that idea. She's a
Uh-huh.
member of our group.
Oh, okay.
And um, but you see, the thing is, the prices are high
Right.
for home prices and projected to increase another 7% next year.
Right.
uh, the mortgage interest is still low, but still the price pressure is uh, what is keeping the people from buying
Right. It's
their
around,
house.
I think the
Hmm.
average or median price is around 380,000 for a single family house. So definitely an anecdotal evidence right there, Wawi, that you have shared to our listeners. So
Hmm.
people are definitely postponing their purchases of large expenditures, not just houses, but also vehicles. So meanwhile, this is a chart from Charles Schwab as well. Non-financial corporation profit margins are still way up there. So big companies, despite their warnings, I mean, back in June, we've already discussing what Google, Facebook, and other companies are forecasting for the rest of the year. And now it's December. It's been 6 months, and they're saying that they might not make as much profit. But looking at this chart, it's still supportive of them being able to generate or squeeze out profit margins. Profit margins are what's left after corporate expenses, after cost of goods sold, paying their employees, whatever's left for them to keep. It's still hovering pretty much at a good level. It's pretty high, but just keep in mind that some of these companies, like for example, I'm not sure if you've seen the news, Wowie, about what's this cloud company's name? Salesforce. There's disclosure. I have Salesforce in my portfolio, but been suffering a good amount of dip because it fell about 6-7% in one day, just because although they met Wall Street estimates expectations, their forecast is a little low compared to what Wall Street was expecting. So they're expecting a slowdown, and they themselves aren't in the business of selling cars or houses. They're selling cloud business, and they're forecasting a slowdown. So these type of things that's currently emerging are definitely some canaries in the coal mine, as one might say, because if I could really be pessimistic here, Amazon, which is a stalwart or one of the strongholds of the Nasdaq index, um, generates a lot of its business or profits from web services, which is cloud. So personally, I think this is a warning, because once the big tech gets hit, and I don't know where we're gonna go from there. But right now, market is still like holding up because of these big tech. But underneath, we are now experiencing, which we're gonna take a closer look as well. We are now experiencing a lot more new 1 year lows in small companies and as such. So this
Well,
is our uh-huh.
that's very likely that that's gonna happen. We're on a down market trend right now,
Right.
but I think cloud computing is here to stay, as well as cloud security going to stay.
Mm.
Disruptions might, I just don't know. Maybe in the far future, disruptions may occur when those cloud computing resources become free of charge. Right now, we're
Oh yeah.
paying companies to provide security
Hmm.
and help us transition these businesses into the cloud infrastructure.
Right.
But I'm seeing some movement in the blockchain space, just like Filecoin. And
Mhm.
now I came across one more uh, cryptocurrency token that's uh, that's moving in on this cloud computing space. And but this is not going to happen in just a year or two. I think this type of disruption may occur, you know, several years down the road.
It's
But
good.
who?
It's good that. Oh, sorry. Go ahead.
No, I'm sorry. But you never know. I'm
Right.
just seeing this trend. Uh, so right now, yeah, I agree. There would be a downtrend,
Hmm.
but I'm gonna see that this downtrend will reverse itself by next year, because really you can't dismiss the cloud. This is part of the infrastructure right now for our economy, and it's
Right.
here to stay.
Hmm.
The disruption will happen when pricing trend for these type of services go down.
You know,
Or
as you've mentioned that, Huawei, I just remembered Microsoft is trying to kick Zoom, or not Zoom, but Zillow's. No, yeah, Zoom Cloud. Because right now, this disclosure, we're using Zoom. I'm paying for its services to do recording and unlimited data storage or whatever to the cloud. But Microsoft just offered a very competitive pricing. I'm paying like $17, I think almost $20 for cloud services on Zoom. But the thing is, Microsoft just came out with a competing product for its teams, and it's just $4.99. So we might actually move to Microsoft now because it's like 1/4 of the monthly payment. So that's one thing to watch out for, definitely, because but in the end, this is like commoditizing services,
Mhm,
less profitable for newbies, for new companies like Zoom. But I think in the end, it's still going to be the big ones that are going to be able to absorb much of the customers moving forward because of primarily the cost. Like that's a big difference, $4.99 compared to $17,
mhm,
$16.99, I think. So that's one thing to watch out for. So this is
mhm.
an article that Market Watch came out with just yesterday, and I'm kind of like in contrary to this. So they're saying the happiest retirees have at least $500,000. This financial advisor said. So the byline is, well, duh, who wouldn't be happy with $500,000? But I mean, before, I'm not sure if you've gone through it, Wowie, that they're saying the best retirement level would be around $1 million because you can do the 8% rule, where you can just withdraw 8% from your $1 million portfolio for every year, and you'll be able to manage to enjoy your retirement. 8% of 1 million, by the way, is $80,000 at least. So if you're gonna do $80,000 withdrawal, the $1 million would last you for a long time.
And the new economy, right? So you can live off your capital gains in dollars on the
Oh,
new
wow, I
economy.
think, yeah, I think we're kind of experiencing some audio difficulties at this time. Um, can you repeat that?
Or saying,
Oh, it's
um,
it's still giving me it's still giving me some audio issues, but yeah, let's see here. So the math behind, they're saying that if you have $500,000, your withdrawal rate from 8%, they're recommending 5%. So you're just gonna live on by $12,000 or $1,000 for the month. So that just doesn't make sense. $1,000 a month to pay for your mortgage and rent and living expenses. I mean, this article is bananas. I don't agree with it totally. They're just trying to lower down the consumer expectations, or whoever they're trying to fool here, but not us. Can you hear me now, Huawei? Or let's see if your audio works. All right. while we're working on our audio difficulties, we're going to proceed with our weekly sentiment, which we haven't gone by for the past couple of weeks because we didn't have any recordings. So for today, this was just published a couple of days ago. This is from the American Association of Individual Investors. We're looking at their weekly survey for December 1st. Bullish investors are now just 26.7%, which is really low compared to the previous month, even in the whole month of November. Now we're at December, and the first day of December, they're at 26.7%. Compare this to November's 48%. Hey, Wowie, now I can hear you. Yay, you're back.
Sorry about that.
That's okay.
These glitches.
Yeah, technical glitches. We have taking a hiatus for 2 weeks, so now we're just warming up.
Go ahead, Mark.
Yeah, so the bearish, on the other hand, we're now at 42.4%. Definitely way up there compared to last month's low of 24%. So people are getting, or investors are getting more bearish or thinking that the stock market will go down in the next 6 months. 42.4% of them, actually. This is way higher, 12% higher than historical averages. The fear and greed index, currently we're at extreme fear at 25 points. Whereas just a week ago, we were still at greed. This is before the new variant came up, I believe. People were still really bullish at that time, 64. Well, now we have dropped about 40 points to 25. And this is graph showing tracking the historical fear and greed chart over time. And definitely a drop from above 80 points back in November. Now we're at 20 something points. And like what we just had said, volatility has been crazy for the past week. We are now 10%, 28 points. And if you're going to look at it on a time frame of a month, we're nearly double from last month. We're now at 28 points, up 86%. And for the past 6 months, we're up 55%. If you're going to look at it starting from the January 1st of this year, we're now averaging at 30 at least. We actually pierced through 30 points just earlier this week. So this is levels that we have not seen since February of this year. So people are quite panicky.
Yeah, people are selling on the news of the Omicron variant. So
right,
we're just seeing that market sentiment.
Right. But people don't like the uncertainty, definitely. So this chart, this graph alone, if you're looking at YouTube, don't worry, for our listeners on our podcast, definitely quite explains what has been happening. So yesterday was quite a rebound. Stock markets rebounded good yesterday. All industries were in the green, led by energy. But for the past week, everybody is down. Utilities, technology, healthcare, real estate, everybody has suffered at least 1.5% decline or more. Consumer cyclical was down 4.4% as a group. But looking at the year to date, the thing that we need to usually go back to justify current stock market levels, we're still in the green, except for consumer defensive. Look at that, negative 0.5%. Interesting. But for the rest, everybody else is more than 2.5% gains as a sector. We're still in the green, guys. Don't worry. Weekly flows. This is a chart from Bank of America. Looks like as of last week, 11/22 to 11/26, ETFs saw the biggest inflows, and tech had the biggest outflow. So people are selling tech, and they're dumping their money in ETFs. And then second goes to energy and consumer discretionary.
Well, that's the rotational trend.
Mm-hmm.
People are expecting the rates to go higher, so they're moving out of technology.
Oh,
But
right. Yeah.
we should see a rebalancing of that once after the Fed Reserve
Right.
complete their initial taper.
Mm-hmm. I think it's coming up, right? This month. It's coming
Yeah,
soon.
they keep saying that they're gonna do it soon, but they haven't done it yet.
Mm,
I think just for the sake of the market, they should just go ahead and do that so that
right.
the market can stabilize itself.
Mm-hmm. So this is a price to earnings ratio that we usually, from time to time look at. The forward price to earnings ratio of the S&P 500 has now dipped to 20.8 points. Well, not so long ago, it was hovering around 22, 23. So we're in terms of sell-off, we're still, you know, if you're gonna consider this a sell-off, we still have not really breached anything here.
Yeah, it's
And
probably just, there's gonna be a little bit of sell off on the
mhm,
initial uh um what do you call this, tapering off, and
right.
before that we're seeing the initial reaction of the market, and we should see more of a dip, you
Mhm.
know once we get definite about when they're gonna taper.
And you said the word, Huawei, the dip. Buyers always like to buy the dip. As we're gonna see in a little bit. There's an article published by Bloomberg saying that there's an evidence that actually retail investors like mom and pops and like us actually bought the dip back in Friday, back in Tuesday, and today's Friday, right? So
Yeah.
retail investors have been buying the dip. But the problem is, Huawei, there's an article also came from the same source that said hedge funds are bailing out. So retail investors are buying, but the smart money, quote unquote, are bailing out. So that's something to keep an eye on. So this is a forward PE of the Russell index. So contrary to S&P 500, which hasn't really experienced any sell-off in terms of their earnings or valuation, Russell, which makes up most of the small cap companies, or those that didn't make it to the S&P 500 companies, has been on a broad sell-off. So blue line, Russell 2000 as an index as a whole, at one point back in 2020 was trading around 50 times its forward earnings, and it's slowly gone down. Right now it's at 27 times forward earnings. So that's one thing to keep an eye on, because people are selling their small cap stocks, probably those high flyers, there's tech growth or small tech companies that hasn't have any earnings yet or whatever, and it's going down. So that's something to keep an eye on, because we're gonna browse through some of the meme stocks and SPACs that are suffering from this outflow or poor performance so far this year. So this is the Bitcoin, a cryptocurrency fear and greed index. Currently, we're at fear. So definitely not a diversification from the stock markets, because it clearly follows what the stock market is doing, although it's open 24/7. So right now, Bitcoin fear and greed is at 31, whereas last week it was at neutral 47. This is an article that just grabbed my attention yesterday. It came from CoinDesk. It says Goldman Sachs sees crypto options markets as the next big step for institutional adoption. So looks like options.
Duh. It's been finally they're seeing the need to diversify their holdings to
Right.
include Bitcoin.
Yeah, and
The two
options.
most popular will be Bitcoin and Ethereum.
Mhm.
Some are moving into holding like 10% of those assets into their portfolio.
Right.
But for me, my opinion on that, I think 10% is still a little bit too high and too risky.
Mhm.
But it looks like that's going to be the trend. The blockchain ecosystem will be the trend for the future.
Right. And looking at this chart provided by the article not so long ago, back in May 2020 or during early parts, the first 3 quarters of 2020. Options market were for Bitcoin or cryptocurrency were just hovering less than $2 billion. But after the September month of September, options trading in cryptos has surged, now more than quadrupling, 7 times now, around 14 billion to 16 billion worth. So Goldman Sachs definitely sees crypto options market playing a role. So this is the going back now to the stock market. So we're looking at quite a drop from Dow Jones just because of the new variant. Friday we saw a 900-point dip. Monday we saw a 200-point surge. Tuesday 650-point dip. Wednesday 460 dip. But like what we said earlier, retail buyers are buying this dips. So just a reflection of the fear sentiment that's been hovering on our radars. So this is a SPAC ETF. So definitely underperforming for the past month, for the past 6 months, and since the start of the year. So SPAC is down at least 17% since the start of the year. So it hasn't been able to recover since the February highs, as we started covering it in our first segment, on our first episode, actually. Oh, no, third episode, sorry. Also for the IPOs, Renaissance International IPO ETF. So it's been trading down since the start of the year. Actually, is lower, 28% lower since the start of the year. Much lower. IPOs are now much lower, the IPO ETF compared to SPACs. So what are the stocks that are in the IPOs ETF? Let's see. So usually SoftBank, Kuaishou, Nexi. So I'm definitely not familiar of this, but this is their largest holdings.
Are
Definitely
those Chinese companies?
looks like SoftBank obviously is from Japan. Kuaishou, not really sure. Nexi, SPA, Adventia. It doesn't say. Let's see. Sector, consumer, cyclical, country. It doesn't indicate which country are they from. But looks like it's broadly.
I think there's going to be a lot of foreign companies trying to IPO in the US stock market.
Yes. And if not IPO, they go through the SPAC, right? Well, to the SPAC combination.
Yeah, I mean, sorry. Yeah, they'll go through the SPAC or try to do an IPO, either one. A lot of these Chinese companies might try to get into this into this SPAC and IPO.
Yeah.
And they'll be popular.
For the SPAC segment, they have the Lucid Group, the Tontine, Pershing Square, Ginkgo Bioworks, DraftKings, SoFi, Vertiv. So these stocks definitely have been underperforming. It's captured by the ETF. So definitely sometimes they outperform, but most throughout the year it looks like they've been underperforming. And I can't find a meme stock ETF. So I'm just gonna go through a couple of them that were really popular back in February. One of them is AMC. So AMC definitely lost a lot of value for the past week, down 17%. For the past month, 26%. For past 6 months, it has lost 41%. Since the start of the year, they're still up 1,400%. Crazy gains. So if you have bought AMC since January 1, congrats to you. Definitely, I wasn't able to ride that wave. GameStop, another meme stock, down 13%. Down 17% for the past month, down 30% past 6 months, still up nearly 1,000 points, 1,000% since the start of the year. So it's just saying that if you've joined the meme wave late, you'll definitely be in the red. You'll be losing a lot of money. But if you were there before the craziness has started, you are in the green. Robinhood, Well, the one that went public recently, it's been trending down as well. For the past week alone, it's down 11%. Whew, past month, down 35%. For past 6 months, down 30%. And I think they just listed. So they just started trading back in July. So since they started listing, they're down 30%. They lost like a third of their value. So the Mr. Market doesn't appreciate Robinhood at this time, looks like. And from their quarterly report, I think they're relying more on the crypto trade. Basically, I think I remember they're saying that it's their trading activities or revenue came from Doji, or most of them. So I don't know how Doji is doing right now. I'm not sure if you're tracking that too, Wally, but it's out of my keeping in track
No, I'm
list.
not
But
really tracking it, but I'm looking at price actions.
mhm.
Up and downs, of course. You could see that on Shiba Inu and Dogecoins. Those are the two most popular coins that are being traded
Oh, here.
in
So
the
I just
market.
pulled up, yeah, Doji at 21 cents. So I'm not sure where it's at. Let's see, 6 months ago. So 6 months ago, oh wow, it just lost almost 50, half of its value for the past 6 months. So definitely quite a ride right here, up and down. One day it'll be at 17 cents. One day it'll be at 34 cents, nearly doubling, and then go down again. So
And
that's
you
quite
should see the
interesting.
same thing on Shiba Inu.
Mm-hmm.
It's an up and down, volatile pricing.
Right, roller coaster. So
So what I did, I shifted my portfolio, my blockchain crypto portfolio, and
mhm.
shifted them more to the more stable coin. Well,
Uh-huh.
I don't want to
Stable
call
coin.
it stable coin, but the more less volatile coins.
Like the
And
Ethereum or Bitcoin, Wowie. Are those
yeah,
two?
Ethereum, Bitcoin, Tezos, and
Mm.
Chainlink.
Oh, well, that's good to know. As long as you're out of the volatile part, because that kind of like eventually will push you to time the market, which is very hard to do.
Yeah.
So here we are looking at one primary example of work from home play. So Zillow's not feeling the love anymore.
Hmm.
It's actually down 18% for the past month. Down. Whew, it just lost. Well, they just came out of one quite headline a couple weeks ago. I think they're gonna stop doing some stuff online, like buying and reselling houses. So they lost 51% of their value, and from the start of the year, they lost 60%. So Zillow Group might not be a good example, but let's take a look at Peloton. Peloton is definitely a work from home type of. Oh, I don't even know their ticker. It's Peton, PTON. So this is
Yeah,
a work.
PLTN.
Yeah, so it's a work from home stock. So people were loving this. Wall Street was loving the stock last year when people were stuck in their homes buying treadmills. I didn't get their stock, but whew, for the past month, look at this, Wowie. They lost half of their value, 50% down for the past month.
Well, I'm pulling up Zoom. Zoom is the same thing.
Uh-huh, Zoom. Yeah, let's look at that too. For the past
It's
6 months, they're down. Peloton is down 57. For the past year, they're down 70%. So big losses. From $150, they're down to $44 a share. Big loss. If you have $10,000, it's now down to $3,000. You just lost $7,000 because of the work from home stock has popped. What do you have for us, Wowie? Do you have Zoom pulled up?
Yeah, I do.
Mm-hmm.
Yeah, so yeah, it's the same. Their chart is also on a downtrend.
Right.
Um, so from a high of about close to 450 down to about 191.
Wow. Yeah. That's
So
more than
like
half.
near 50% drop
Yeah,
in here.
obviously. Huge drop. Although
And
we're
that's
still using it.
after beating their earnings expectation. Well,
Uh-huh.
it by 2 cents.
Yeah. So they beat Wall Street expectations. Still, they're down. But yeah, you're right. Looking at it from the start of the year, they're down 47%. And Microsoft just came out with their competing product Teams for $4.99. I'm seriously gonna look into it this weekend if we're gonna move on to Microsoft, but we'll see. So reopening play this time. Wowie, I have here Uber. Let's see how Uber's doing for the past month. Oh, contrary to what we were expecting, it's down 17% for the past month. Might be because of the sentiment that's been ongoing. People, Wall Street has now been entertaining fear instead of greed. So they're down 17%. Definitely not not what we were expecting as a reopening play
Well,
as
there's a
people
little
go back.
uptick there.
Mhm.
There's a little inflection there, a little uptick on its
Little
chart.
uptick, yeah, from Wednesday, from yesterday. 6 months they're
Air-
down 22%.
Airbnb. I'm checking out Airbnb. That's another.
Right.
Okay. Airbnb is somewhat better amongst all of these uh, charts that we're looking at.
Right. Definitely they're a reopening play, right? Because people would need to book somewhere to stay. And Airbnb is the largest among them on online marketplace for lodging and stuff. Yeah, you're right. So for the past month, Airbnb is just down 2%. Past 6 months, they're up 17.6. Since the start of the year, they're up 20%. So that's a good sign. So
Yep.
regardless, this is an article from Market Insider. They're saying the stock market is extremely oversold. This is 16 hours ago. And a rebound is likely, according to a technical analyst.
Well, I think
So,
that's been a year ago that things are oversold.
so according to KT Stockton of Fairlee's Strategies, our market internal measures are flashing collective oversold extreme with 4 readings flashing green for the first time since September 24, 2020. This creates a backdrop supportive of a strong rebound. But if a rebound doesn't materialize, it would be a reason to expect a more prolonged correction. S&P 500 needs to rebound above 4540. So this is quite getting into technicals now. So if it doesn't, it's going to fall more, somewhere around 4300. So for me, I don't really like base my investment or strategy with these kind of forecasts, especially drawings and stuff. But it's something to keep an eye on. So this lady here at the analyst is saying that, we need to rebound probably quite soon, or else we're going to see more correction ahead. So interestingly, Barron's came out with this with this article, a bullish or somewhat announcing or pronouncing Tesla as a defensive stock nowadays. It's no longer a high-flying speculative stock. It's now a defensive stock. So they're saying that overall, this article just summarizes that Tesla has been holding up its ground despite the sell-off. According to Dan Ives. Dan Ives is a well-known analyst. He's being interviewed a lot in Bloomberg and other financial news websites. According to him, quote unquote, it's a twilight zone world that Tesla is actually viewed as a safety blanket stock in rocky times. He has a price target of $1,400 a share compared to $1,100 yesterday. So if you're going to look at the graph, S&P has been trending down and Tesla has also been trending down. So I don't see the point that they're saying that it's a safe haven. But regardless, Musk has been definitely selling some of his stock. So this is a comparison of Tesla stock for the past month. Let's see. Because this is when we started seeing some drawdowns, actually for the past week. So yeah, it's been somewhat steady, but it's still lower than the S&P 500. S&P 500 is down 2%, while Tesla is down 11% since a month ago. So I don't see the point of that article, honestly. So this is going back to the SPAC thing. So SPAC is a bust. So Grab, I remember while we discussed Grab's financials back in June or July, when they said that they're gonna merge with one of the companies here in the US. So interestingly, yesterday they opened up 19%. And then by close, they're down 20%. So that's a 40 percentage swing in just one day. Definitely indicating that Wall Street isn't any more happy with the SPAC activity. So Grab is like the Uber of Asia. Actually, Grab uh, overtook some of Uber's operation in some countries. I think Uber has a 16% stake in Grab. So is some basically the price action on this company um, summarizes what Wall Street expecting on the company. It's a super app, according to one of the analysts here. It's a Singapore-based company that makes a super app offering ride-hailing, delivery, and financial services in more than 400 cities in Southeast Asia. So, despite its wide-ranging capabilities of offering services there and taking a commission out of it, providing its services, Wall Street isn't happy. It's down 20% by the close of yesterday. So this is interesting. Jumping on to our next article. This is an article from Bloomberg. JP Morgan strategist says buy the dip as Omicron, the variant, may accelerate pandemic's end. So sorry about the dogs. It's making a lot of noise. Can you hear? Can you hear that, Wawi? Or is it?
Yeah. Yeah.
Okay. Yeah. Give me just a second. Let me see if I could tame it down.
Okay.
All right, now I close down the windows. Hopefully that kind of tames down the noise. Sorry about that, listeners. So, JP Morgan advises for its customers to buy the dip, which is interesting. Despite the declining consumer sentiment and the rising inflation and the dipping of the market fears, like sentiment in average, in summary, because we're now looking at very low sentiment for investors. So this is going
I think
against
the
the grain.
investors are just taking the risk off, right? And
Right.
just rotating their investments to more of an income type, more value type rotational move.
Right.
Because I think the overall sentiment is still bullish. It's just that they're taking their risk off their investment.
So this is a direct quote from the JP Morgan strategist Marco Kolanovic and Bram Kaplan. This is a note that they wrote yesterday. So, quote unquote, Omicron could be a catalyst for steepening, not flattening of the yield curve. Rotation from growth to value, sell-off in COVID and lockdown beneficiaries, and rally in reopening themes. We view the recent sell-off in these segments as an opportunity to buy the dip in cyclicals, commodities, and reopening themes, and to position for higher bond yields and steepening. Oh, so it's a reopening place, the stocks that we just looked at. Airbnb, Uber, maybe Lyft. What else are good for reopening? We need to take a closer look at that. And investors should shy away from those work from home stocks, which they are definitely doing already.
Well, definitely Microsoft, right? You just mentioned Microsoft.
Microsoft will be a good one, yeah. Big tech.
Yeah.
So this is a warning shot too. This is the next article where we're looking at. This is entitled "Apple Tells Suppliers iPhone Demand Has Slowed as Holidays Near." So it looks like in this article I read it earlier that Apple is cutting its iPhone units or production goal by 10 million, from 90 to 80 million. So that's a whole lot. Negative 10 divided by 80. In terms of percentage, Mhm.
that they've been telling their supplier that the demand for their iPhone 13 is low.
Right. Yep. So they're looking at a 13% dip in terms of their units order requests. Which is interesting because Apple is the one basically holding this market up, aside from Microsoft, Amazon, and Google, the big tech FANG stocks. So something to keep an eye on. If it continues to slow, so cloud services is slowing down, sort of, and then Apple, consumer products is slowing down. Could that be an indication that aside from houses and large item purchases have been definitely, on the slower end at this time? Even these consumer discretionary products are also slowing down. So this comprises most of the US economy. So we're going to see it in a couple months, or at least in the next quarter. So this is the um interesting point that we're looking at uh in a future time period. So this is an article from Bloomberg. Dip buyers resurface in dizzying week for stocks. So as we pointed out earlier, dip buyers are circling around, according to Afan Devitt, chief investment officer of Moneta Group. "Quote unquote, what we are seeing is the propensity to buy the dip. And why are we buying the dip? Because there's just so much money sitting on the sidelines. Huh.
Mhm.
Even though these short bouts of volatility are surprising and certainly have sent a chill through the markets, we still have a significant bank of equity returns to enjoy year to date." So they're looking at that, kind of like summarizes what's going on at this point in time, because regardless what the stock market does, if it goes down, retail investors are buying the dip, mom and pop investors. But here's the thing that I pointed out earlier, that the smart money is actually bailing out. So
Mhm.
hedge funds, according to this article, bail from stocks as Powell COVID royal markets. Index of expensive tech stocks plunged 7.1% on Wednesday. So add professional traders to the ranks of investors bailing from stocks as anxiety over the Omicron variant and monetary policy roil markets. Hedge funds, which use borrowed money to amplify returns, have gone risk off in a major way, just as the S&P 500 endured its biggest two-day rout since October 2020.
Yeah, I
So,
agree with that.
mhm,
With that analysis. You know, um, but that's gonna be just for short term, in my opinion, because our our signals are still strong. Jobs are increasing.
right.
We're just having a supply slowdown.
Mhm,
Should normalize by maybe next year. Um,
mhm,
More chip factories coming online in the future.
mhm.
So it's gonna be slow for a while, but it should pick up.
Yeah, but according to this article, the move is in contrast to retail traders who renewed their manic dip buying after Tuesday's rout, pushing
Yep.
stocks higher by almost 2% earlier. Then Jerome Powell reinforced his message that the Federal Reserve would keep inflation in check, and officials confirmed the first case of Omicron variant in the US. That sparked an afternoon sell-off that left the S&P 500 with its biggest reversal since April 2020. So we've been in a volatile week so far, Huawei, and I think futures market are telling us as of this time that we're gonna be on the red. Let me see this futures market.
We just need some good news, and I think part of that good news that we need is who's gonna be the new bank chair, right?
Mhm. Oh, the
Uh,
federal chair? It's gonna be Jerome Powell. I think Biden already has named him for his second term. He stick with the tradition.
no, I mean the chair for banking, and
Mhm.
um, I'm trying to see who's that gonna be. I know the Fed chief is still gonna be Powell, and that's good
Uh-huh.
news.
Okay.
But
What? Uh-huh. Yeah, well, looks like the futures are up, Bobby. We're at 36 points at Nasdaq and up 50 points, 48 points in Dow. So far so good. We're starting the day slow. Last day of the week. First, I think everybody's watching out for that number, Bobby, since this is the first Friday of this month. Government will be reporting job numbers. So that's something to keep an eye on. Hopefully, it exceeds expectations. Whereas the ADP report, which came out yesterday, is quite nice, quite positive. People are hiring from small to large businesses. So this is what's interesting that caught my attention too. This is an article from CNBC. CEOs and insiders sell a record nearly $70 billion of their stock so far this year. So sales by insiders are up 30% from 2020 and up 79% versus their 10-year average, according to Insider Score Verity. So, if this is a really good picture or graph that CNBC came up with for our listeners, don't worry. So this is nearly 80% higher so far this year that insiders have been selling. We're at 69 billion, nearly double of what we have back in 2016, 2017 period.
Yeah, that's not a good sign.
Insiders are bailing out. So if you're going to look at the big tech, the largest, coincidentally, big tech are the largest stock sellers. Elon Musk alone is 1/6 of the insiders selling, which is so nearly he sold 10 billion in 1 month since that tweet. Jeff Bezos, this guy has been quite sleek. He's not making headlines, but he had sold nearly $10 billion as well so
He's
far this year. Quiet but lethal. He's been slowly escaping. Whatever the reason behind it, I don't know if they're just timing the market or whatever, but this is a bad sign if something else is wrong with the company. But I don't think Amazon has some issues aside from possible web cloud services slow down. But we'll
Well,
see.
who's doing any buybacks right now? Do you know?
I think it's still tech. I saw a Bank of America report a week ago. I saw tech is still leading the buyback activity aside from banks. Banks are actively buying its stock. Walton family came up a third. The Sam Walton. This is the family that hires and irises, the ones who have inherited Sam Walton's Walmart business, Sam's Club as well. So they've been selling a bunch. Well, they've always been selling a bunch. I think even last year, since I've been following insider selling, Walton family has been, just selling their stock. Mark Zuckerberg, the metaverse or Facebook founder, nearly 4.5 billion, and the Google founders, each of 1.5 billion. So these group of guys consists nearly half of the $69 billion insider sales so far. So we just have a couple of videos to play. Are you ready for a roll the clip segment, Wawi?
Okay, roll it.
All right, let's see.
Fundstrat's Tom Lee is on the phone. Tom, you there?
Yeah, I'm here, Scott.
Tom, yesterday you were out with a note, buy the dip. Today you're out with a note, buy the dip. Why are you so sure?
Days like today are tough because, markets don't like uncertainty. Omicron and then the Fed's comments are a surprise to market. But I think investors have to think about what matters more to the economy and markets in 2022. And I think the Delta and Omicron, these viruses really only do flesh wounds to the economy. But the fact that inflation risk is cooling, and it's part of it is because of these border closures. And I think even Powell's comments are really cooling the inflation risk. If you look at the break evens, they've fallen a lot. I think if inflation is less of a problem in 2022, that's actually a tailwind for markets. So I'm still in the camp that, it's unfortunate to see us make new lows, right? Because we should have been just testing the lows of Friday, but we're actually breaking lows. But I'm encouraged by the fact that even though VIX is surging today, it's not even making new highs versus Friday. So I just think markets are at a buyer strike. People are, waiting for the dust to settle. But if you're an investor, this is the time you want to actually be buying these shares coming out of panicked hands. So yeah, it's awful. Like today is just horrifically bad, but I'm still in the camp that you want to buy this dip.
So he's still bullish, Huawei. This is also as of November 30. So he hasn't changed his his call in the market. Just buy the dip. Keep long. Keep that bull spirit.
Yeah.
And
In a way, I'm the same way with Tom Lee. Yeah. I'm still bullish for the market.
right. Oh yeah, we had that poll that I made yesterday. So the poll that we have in our group said, will there be a Santa rally for 2021, which is, this year, the remaining weeks of this year. And most of the members in the group, including me, were on the bearish part. We said no, but you on the other end was remaining bullish, at least for the next 6 months. I mean,
And
not
that's
6 months, for the remaining weeks of the year.
Yeah, that's just based on some news I'm gathering about the variant. So we saw a downtrend when we first got the news about the Omicron variant, but looking at the latest news about it being less virulent, I'm being hopeful. And after reading an article about an immunologist in Israel about his statement regarding the Omicron,
Right.
I'm a little bit more bullish about the market, and I'll read it on our quotation segment.
Mhm.
That he's
Okay. That'd be nice. Yeah, because I think Omicron is not that as bad if you're already vaccinated. That's my take on it. But yeah, sure. So our second video or last video for this episode is one from JP Morgan. So let's roll the clip.
No, Wilfred, I think we really are sticking to our 2022 playbook. And that's not just because we spent a lot of time working on those year ahead outlooks, but just because they haven't changed over the past week. So we still have a lot of information that we don't know about Omicron, but we do still expect next year to gradually move on from the pandemic, given how much we've adapted to it, as well as our new medical solutions. So gradually we should see a re-acceleration in growth around the world, combined with slightly higher inflation, but with global reflation. This should be very good for earnings growth, with expectations actually a bit too low, with room to move higher. This should be a good year for the equity market, a much better year diversified by company, style, sector, and region. And it should be a much more challenging year, unfortunately, for the bond market. And we should continue to see this volatility in the curve as we debate inflation and we debate the Fed's reaction from trade. So it's actually our expectation is the complete opposite of the market performance that we're seeing today. And we don't see reason to change that positioning as of yet.
Lindsay, in terms of what to buy on these pullbacks, what are you telling your clients that's attractive in the short term following those pullbacks?
Yeah, I mean, I think what you've seen over the last couple of days is more of what you've seen all year long. There's been rotation in and out of the cyclicals and values back into the growth. And we've seen a push and pull between those all year long. It really makes the case for having that diversified portfolio. But as you think forward to the next year, where I'm with Gabrielle, I don't think that the playbook changes. I think this is more of a hiccup near term as far as growth is concerned. And we might get a little bit of a slowdown. We're still assessing what the economic impact is going to be from Omicron. And we're assessing what Fed policy is going to be going forward. And I think that the reopening is going to continue to benefit economic growth and corporate growth. Consumers are out there spending. They are still optimistic about the future. They're looking to get out and reopen and get back to work. And so I think that with CapEx, IT spending from corporations, a rebuild in inventories, that's all a positive for the economic environment going forward. So we're sticking with some of the value and cyclically oriented sectors into the new year, especially on any pullbacks like today.
Gabriella, what is your playbook? So when you say that you're also cyclical, what are you exposed to? Which sectors?
So the first thing would be to be overweight equities versus bonds, expecting positive equity returns and unfortunately negative bond market returns, so the opposite of today. In terms of adding cyclicality, I think it's absolutely the time to be adding the value style to complement the growth exposure. That way you participate in days when growth is up as well as when value is up. It's also about adding a lot more regions beyond just the US. So also adding cyclical regions like Europe and Japan and growthy but less expensive regions like China as well. In terms of fixed income in that danger zone, it's really still about underweighting duration and focusing much more on credit risk than interest rate risk. So overweighting high yield, for example, versus investment grade. That's really the playbook for 2022. If you look beyond just 2022, it's really about moving on from just beta, from just index investing, to focus a lot more on the alpha, because otherwise the return expectations we have for the next decade are only 4.3%. So we need to be able to pull some different levers in terms of active management, different asset classes, and different tactical investments as well.
So JP Morgan is playing a very bullish tune in terms of a stock market. I almost unplugged my computers. Plugged in there. We're still doing remodeling, so everything is not fixed yet. But JP Morgan is sounding bullish at this point in time, Wawi.
Yeah. Well, I am too.
So they're saying go high yield instead of investment grade bonds, go buy equities instead of bonds,
Yep.
be more into value instead of growth. And what else? Yeah, she's very much bullish. You know what kind of reminds me of? That reminds me of that Morgan Stanley. The guy from Morgan Stanley, we've been having his interviews played here, and he's definitely in the bearish side. And he's actually, what he had said a month ago is now playing. A fire and ice.
Mhm.
The Federal Reserve trying to taper down, and earnings growth is slowing down. So definitely quite interesting. And going back to this lady at Bank of America, no, JP Morgan, she's saying that over the next decade, we should actually try to pull some levers elsewhere and find active management to outperform the market, because overall S&P as an index alone would just be returning very low numbers of 4.3% a year. On average, since I believe years back, multi-decades, 30, 40 years since the stock market, usually stock market returns, S&P averages 7% on average. So S&P will be underperforming, just returning 4.3%, which is, something to watch out for.
Yeah, I've been reading some stuff like that too, to diversify away from the S&P 500.
Mhm.
But you can't, if you're not an active investor, there's no better way but to invest in the S&P 500, in my opinion. But
Right.
again, the players will change. The composition of the S&P 500 will continue to change over the years. So I
Mhm.
think it's good to invest in the S&P 500 and
Right.
then look at some undervalued equities that's out in the market. And there may be some more dips coming in the near future, but I still see an uptrend.
Mhm.
We've seen so many surprise gains in the past 2 years that I think that's what's driving my bias right now on the bullish trend.
Right.
So,
And this is a timely chart provided by one of the Bloomberg analysts. It just, for our listeners, don't worry. This is a chart that's showing the Russell 3000, which consists of almost all of the stocks listed. No, not all of the stocks listed in stock market, but the majority of it, 3,000 stocks on average. His chart indicates that there's no alternative when referring to U.S. stocks over the long term. As you can see here, back in 1990s and to the present, the US stock market has outperformed all the bond indices, all the global stocks, all the commodities. and a 31-year approach. So I'm kind of jumping on the same boat now, Wowie. Because you can see here, well, obviously the top 10 holdings will be the big tech, the biggest of them all. But for the past 31 years, they've been outperforming.
Exactly. If you look at the historical trend, there's no way but to be bullish. But again, you have to look at your own investment time horizon. If you're nearing retirement, then you may want to be more, conservative about your holdings.
Oh, Wowie, some news flash just came up from CNBC. This is about jobs numbers. So job growth disappoints in November despite high hopes. This is not this is not an article we want to see this morning for sure, because futures is barely hanging on. Yeah, according to this publication by CNBC just now, just one liner. They're still updating it. Non-farm payrolls were expected to increase by 573,000 in November, but I think it's a negative number. But futures are still positive. 46, barely hanging on. Yeah, it's still positive so far. I don't see any negative pullback at this point in time. But yeah, for now, I guess that summarizes our our weekly highlights. But before we go, Wowie, do you have any quotes for our listeners?
Yeah, so this is from Granite. He's the immunologist in Israel, looking at the Omicron variant. And he said, when you look at the future and you try to envision how this will end one day, it's most likely not going to be because we got a fantastic vaccine. It just doesn't work this way, and we have a lot of experience with viruses like the flu. The way that it will end, in my view, is when we encounter this new variant that is highly infectious, but is not very aggressive, meaning that a lot of people will get infected, but none of them will develop serious symptoms. And in a sense, that will be the way the population will really gain herd immunity.
Okay.
And then the virus will just fade away.
So we're on the right track, looks like, because this variant at this point in time is not really like detrimental to those already have been vaccinated. So that's a good sign. But I think, Wowie, the overall point here is when Jay Powell starts hiking rates because of inflation worries, and that will be detrimental to the stock market, looks like, right?
Yeah, for the short term, but it will help the market stabilize and normalize.
Right. Well, at least that will bring a little bit more sense to the market, a lot less optimism. Not sure about that, but we'll see how it goes, right, Wowie?
It will be based on real earnings and
value and real earnings. Yep, that's where the JP Morgan analyst just pointed out. If you're gonna, that's her outlook for 2022. Oh, by the way, Goldman Sachs came out with their best trading, not best trading, but their outlook for 2022, and one of their and their top trade would be long oil. So that's something to keep an eye on, as oil has also dipped, almost entering the bear market just this week. So we'll see how that goes.
Bargain out there on the energy sector. So look at those beaten down energy sector stocks and equities. You'll definitely see some good buys there, like Chesapeake Energy, for one, that I can think of right now.
Right. Well, we might go through that on our next episode. For our listeners, thank you for staying with us. If you're still here until now, thank you. If you wouldn't mind, if you're not subscribed, hit the subscribe button. We appreciate each and every one of you. Well, Wowie, thank you so much for coming on. Listeners, that does it for this episode. If you have any questions, just send it over to markyouwowieshow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu, signing out.
Signing out.